Hello everyone and welcome back to my channel, VUCA Insights, where we talk about investing, entrepreneurship, as well as a lifelong journey of growth. Today we're going to cover a very interesting company that's about to go listing as well on the ACE market. It's called ECA Integrated Solutions Berhad, or ECA Integrated Solutions for short. And we're going to cover its business model, we're going to cover the growth prospects of the company, the financials, as well as the risks involved if you were to take a position in this company. So stay till the end of the video to hear my thoughts, me laying out the facts, and more importantly, to understand what are the risks you'll be taking. As a disclaimer, I do not own any shares in ECA Integrated Solutions Berhad because it's not yet listed. I'm neither a promoter of the company, and therefore you should use this video for educational purposes only and to build your mental frameworks to invest in the automation solutions industry. And if you do need license advice, please do speak to a licensed advisor. So first up, what does ECA do? They're a leading design and manufacturer for automation solutions, and we have a slew of these companies in Malaysia who are in the automation solutions, or we call them ATE, or automated test equipment suppliers. These are the likes of Vitrox, Me, Pentamasters, the Greytex, the Genetex of this world. However, ECA claims to stand out because they are a specialist in what they call an integrated production system. That means they don't just supply the tester, which they do as a standalone automated equipment, but their specialty and the chunk of the revenue actually comes from an integrated production system. That means they supply the entire production system from end to end, including the software and the enterprise, kind of like the enterprise resource planning for these systems. And I guess that's where they differentiate themselves among the standalone testers, because the testers sometimes they have to rely on other equipment vendors like the handler vendors to actually integrate this together to form one complete manufacturing system. And this is where ECA claims to stand out and be this unique solutions provider for this system. In terms of industry, they are very concentrated in the semiconductor, automotive, e-mobility, electronic devices, as well as energy. And in energy space, they mean specifically more to the solar photovoltaic assembly and manufacturing. So the products that they have include modular platforms, rotary handlers, pick and place handlers. I know these are a lot of jargons and terms, especially for those not familiar with the semiconductor industry, but over in this video, I'll briefly show you some of the pictures of how these machines or this equipment look like, to give you a glimpse of why are they important to the industry and why are they important especially to the integrated production system that ECA actually does. So you head over to ECA Integrated Solution Berhad's website. They do depict some of the key products, and one of them is this integrated production systems module. As you can see, there are multiple system modules that make up the entire production system. And I'm going to focus briefly on this thing called the automated vision inspection. And this is where the likes of Vitrox, the likes of Me, the likes of even, I would say, Pentamaster or even MMSV, while they are in different niches, like Vitrox is into PCB and MMSV is more into LED, but they all generally are categorized as an inspection system or an automated test equipment vendor. Where ECA stands out, and this is where they claim, is that they can integrate all this together, including the handlers. Now, for those of you unfamiliar with the semiconductor manufacturing industry, the tester's function is to actually test that product or component. However, to move the products or components from a particular tester to another tester, you actually need this equipment called a handler. And this is where things like your linear motor pick and place, okay, your robotic pick and place, these are examples of handlers, including your modular servo press. Now, servo press, I think, is more for compression. That's my guess. But at the same time, a complete production system will require both the tester as well as the handler, and is included all into part of ECA's production system module here. So how much do they intend to raise from this IPO? They target to raise about 25.5 million, and the breakdown is actually given here. 7.7 million, or about 30%, is used for acquisition of machinery. The other 14 million, or 54%, the bigger chunk, is actually earmarked for working capital in preparation to taking on more jobs. And last but not least, another 3.8 million to be used for repayment, par down bank borrowings and listing expenses. Actually, it's not too much of bank borrowings, because listing expenses will easily, cost roughly about 2 to 3 million already. So probably they're paring down about 1 million in bank borrowings, which is actually pretty decent. Now, my thoughts on the high amount earmarked for working capital is this. Now, if you think about an systems integration or systems contractor like ECA, they actually need a lot of working capital, because orders are actually very, very short term. The orders are usually given within the 12 months, sometimes expected delivery within 2 to 3 months if the solutions or the systems is not very complicated. But anywhere it ranges from a few months to roughly a year. And within this short period of time, integrated solutions or integrated manufacturing providers like these, they actually have to buy a lot of short-term inventory, like your pneumatic controllers, your pumps, your motor, and these have a very short inventory life, because they are assembled into a system and quickly actually deployed to the factory of the customer so that they can be up and running. And this cycle is very, very fast. And the struggle for most of these contractors is actually, the moment you get a job, do you have enough working capital to stock up your equipment or your components to actually assemble this production line? It's very different. It's very similar to the construction industry, where if you want to take on a bigger job, you have to pay for raw materials like cement, concrete, and all these kind of things. And in their scale, it's definitely much smaller compared to a construction. But at the same time, the nature of working capital intensity is still there. However, here is the other side of the benefit. You do not have worry of stocking up inventory that may not be usable in the future, because a lot of these parts are reusable, especially once I come to the supplier and some of the customers list later. Equipment like sensors, your hydraulic controllers, your pneumatic controllers, these are bought from guys like Festo, bought from guys like Omron, and they have a usable shelf life for other projects as well. So in a way, while it's working capital intensive somewhat, however, this inventory is not like it devalues very, very fast. So that's the beauty of this business. Second thing is, in Chinese we say you don't need to tun huo. That means you don't need to stock up, because once you stock up a lot of these things, you actually lock up capital. And that is where this just-in-time kind of model, if you've not heard of it, is literally getting the supplies just in time, ready for when the orders are actually ordered. So you think of it like a McDonald's value chain. You don't pre-cook the burger patty before the order is dished out, because the patty will go cold and the burger will go cold. Very similar in analogy if I were to compare it to just in time for ECA solutions. Next thing I want to highlight is this. The beauty and also the detriment of a business like ECA is that you cannot compare order book till probably 5 years from now. One is they'll struggle for obsolescence. You cannot be ordering, customers wouldn't order, especially technological advanced automation systems like this 5 years in advance, because technologies rapidly change over that 5 years. And therefore, a lot of this equipment, they buy them probably with a 1 to 2 year look ahead. And they know the capacity. Let's say their customers are growing another production line. They come to ECA and says, can you deliver this within the next 12 to 24 months? And that's why order book visibility is a little bit more short term. Okay, that's their advantage, but also the disadvantage. If you're looking for investing in a company that has recurring revenue, this is something that ECA may not have from their engineering and supply of these automation solutions, but they may get them in the form of maintenance contracts. And right now, that chunk of maintenance contract is small, but it will grow over time as they get more and more customers that have a bigger installed base. So there you go. There's a pro and con of investing in a business like ECA, similar to other similar businesses like Vitrox, the Pentamasters, the Me Technovations of this world. So be aware and place that into your mental model when you evaluate all your investing options. ECA also provided in the prospectus a breakdown of revenue based on industry segments, like in FY financial year end 2019, semiconductor made up a big chunk, 78.9%. 2020 it dipped 31%, but now it's slowly creeping up to about 33%. And where they have really picked up and really gained growth was actually in the telecommunications industry. From 2.4 in 2019, it basically jumped to about 24.5 in 2021 financial year end. And the advantage of segregating into sub-segments of this, even though they're all in electronics manufacturing, but the beauty is that within these sub-niches of the industry, there's laggards as well as there are leaders. So they can play around the cycle in which, like, I've covered a company called SAM Engineering, and if you want to know more about that, you can check out a video on the right, okay? You can adjust your resources, adjust your sales based on the growth of the cyclical nature of that particular industry. In Sam's case, during the downturn of the aviation industry in 2020 and 2021, they focused more on semicon, where they were seeing a huge growth. In this case, they may not be diverse in industry, but the telecommunication, the solar, automotive, and semicon, they all experience different peak and trough cycles within that sub-industry itself. So I think it is an advantage that they diversify into different sub-niches, even within the same industry itself. Overall, yes, they will be impacted because the semiconductor industry is now on a downtrend. There's talks of oversupply in the market. However, those who are looking at investments over the long run and businesses over the long run, there's still definitely an uptrend for the semiconductor industry. So ECA has semi-revealed some of their major customers. The reason why a lot of this is shrouded in secrecy is because most Malaysian manufacturers or equipment vendors, their big advantage is actually cost, labor costs. And by revealing too much of this labor cost, it puts them at a disadvantage, as well as their customers. They do not like to reveal too much of the inner workings and how do they maintain costs, because their competitors can actually go to someone like ECA and say, hey, how much do you build the line for them for, and all this lah. Even though within industry insiders, you will be able to somehow scuttlebutt and get this information, but to the public, they have managed to get away and saying that this is their business competitive advantage, and because of that, they did not need to reveal all this in specific names. But you'll be able to guess. They did drop clues and hints. They said some of these companies are subsidiaries of a German public listed company. So if you do enough research, you would be able to guess some of these customers that they have. Customer concentration is not too bad as compared to some of the players within Malaysia, where customers can make up 70, 80 or even 90% of their revenue. In this case, customer A1, 41%, customer A2, roughly about 40%. Still quite high concentration for these two. But even then, it's not like, a company I covered quite recently that IPO'd, Betamac. If you've not watched that video, I'm going to add a link to the right as well. 89%, if I'm not mistaken, comes from Produa, one main customer. The rest are spread out, but very insignificant. So, I think for ECA's case, not so bad lah. At least two major customers bringing in roughly about 40%, rather than one customer bringing in 80%. Let's start looking at the financials, and we're going to start out with the balance sheet. As of 2021, you've got roughly about 26 million in assets. What really caught my eye was this total receivables of about 10 million. Why it caught my eye is this. I have this certain rule of thumb that receivables should not exceed 20% for most industries. Of course, it differs from industry to industry, especially in the construction industry. It's very notorious for having huge receivables as a ratio against your revenue. And in ECA's case, I remember this number while I was scrolling down to the income statement. Their revenue is about 20 million. So the receivables is about half of that of revenue. They could argue, they could counter argue that says, hey, my orders are anywhere between 6 to 12 months. My deployment of this equipment is very fast, and therefore high receivables is something of the nature of the industry. However, obviously, I would personally prefer receivables to be not so high, because receivables do have a risk of being written off as a bad debt that they may not be able to pay. And we only have a 3-year history here. We've not seen numbers from 2016, 2015, or even earlier 2018. But therefore, it actually raises an orange flag for me, because receivables are so high. I just want to see, like in 2019, obviously they had a smaller revenue, about 7.6 million, and receivables was still half, about 3.5. So there you go. Maybe this is just the nature of the industry, but it does raise a little bit of a concern for me. So on to the income statement, or the profit and loss statement. As expected, companies who are automation vendors usually have command a very high gross margin, and this is the similar case for ECA. On a revenue of 20%, their gross profit is about 11 million, which means it's about 50 to 60% gross margins. If we look at their profit after tax, or net profit to the company, 8.1 million on a revenue of about 20 million. So you're looking at roughly about 40%. Okay. As expected, these are the numbers that an automation solutions provider usually command. Obviously, the administrative expenses, which include salaries and all that, is not as high as what you would see in other developed and Western countries, or even countries like Korea and Japan, where engineers are paid much better. But there you go. This is the nature of the business, and this is the nature of the industry. They do command a very high margin. On the cash flow side of things, I usually zoom at this thing called the net cash generated from operating activities, or in short, operating cash flow. They did have a negative year in 2020, where I think about 6.8 million. Again, you see, the years when they had high receivables, as I pointed out while we were covering the balance sheet just now, this is what will be detrimental, because your money is actually stuck at the customer. They're not paying you fast enough for you to recognize positive operating cash flow for that year. And in years where they can collect better, when the receivables are low, you can see that the operating cash flow will naturally be positive. This is usually a struggle for most companies, is because you want to grow sales, but then you give a little bit of leeway and extend credit terms. And when you extend credit terms, the customers somehow will find a way to drag you. Obviously, who doesn't want to drag you? The longer the better, right? I'll pay later, because there's no interest being charged. Always watch out for the receivables. That's one thing I always do as part of my basic checks. So what are the risks involved if you were to take a position in ECA? I would list 3 major ones. Obviously, this is not as exhaustive. However, these are the 3 major ones I consider you should be looking at and paying more careful attention to. First one, customer concentration risk. Remember earlier I talked about 2 major customers bringing in 80% of their sales. Obviously, it's not as bad as some where, like someone like Inari, a big chunk of their sales actually come from only one customer. So weigh your risk, guys, on customer concentration. Second big risk is the cyclicality of the industry and the customers they are serving. They can only grow, people only buy machines if their customers are actually growing. And if their customers are undergoing a slump because their customers are not buying products from them, therefore ECA has no machines to sell. There's no need to grow a conveyor system. There's no need to grow a production system. And that's where ECA will have, or ECA is at a victim of the cyclicality of the industry as well. Obviously, I'm very, very bullish for the semiconductor industry over the long run. But however, we are still subject to the troughs of an oversupply market. That's where people start throwing prices. There's no longer pricing power. And therefore, major customers of ECA will definitely hold back as well, right, over the short term. The third risk I see is actually ECA not having long-term contracts with their customers. As I explained earlier, the nature of the business does not allow them to bill or contract out 5 years in advance, because 5 years in advance, there's a lot of risk of technological obsolescence. And therefore, if you're looking for sticky customers, recurring revenue, this is not a business that you would want to invest in. It's unlike Apple, where if you're an Apple customer, the moment you get into the ecosystem, you're already very sticky. It's very difficult for you to switch, and therefore you pay either a subscription cost, you pay for an iCloud service, or you upgrade to the next iPhone. It's still within the ecosystem. You buy an AirPods. They don't command consumer stickiness or consumer branding power like that, because one, they're a B2B business. They're usually on the back end. It's unseen, and they rely a lot on the demand from the end products that their clients sell. Like, for example, if they serve the automotive industry, if the car sales is taking a hit, the guys that they serve, the clients that they serve are taking a hit, and therefore they will not be securing any new products to be sold as well. So there you go, a quick overview and my thoughts about ECA Integrated Solutions. If you think this video helped you build better mental models of understanding the nature of this business, please subscribe to my channel, give it a like, hit that notification bell so that you know next videos are out, and help me spread the word on how to invest better and how to turn yourself into a learning machine. I'll see you guys in the next video.